we have this. Welcome everybody to our investor educational webinar series. Today we're going to be covering what to look for in apartment investing legal documents. This is one topic that I think all investors, especially passive investors, need to know, just because you get this thick document from the deal sponsor or the syndicators every time you want to invest in a deal. And I think it's very important for everybody to know on what to look for. Especially there are some key sections which I think Cindy and Greg is going to be going through in a short while. So let me just go with my introduction, and I'll pass it to Cindy and Greg after one slide from now. So let me put this into a slideshow mode. Okay, so just to introduce myself, I'm with Achieve Investment Group. We are a private equity firm focusing on raising money from private investors to buy, manage, and hold apartment asset class. Of course, we always strive to deliver above average return on investments. Right now, we own around 340 units, primarily in San Antonio area, with control of more than 25 million in asset. And recently we won the 2017 San Antonio Apartment Association Property of the Year. This is last week news, so it's hot from the oven. Any contact or topic that you guys think that is interesting and something that you want to know or be educated on, just send me a mail at my email listed here. I think that's it from my introduction. I'm gonna let Cindy and Greg go ahead and introduce themselves.
Hi, everybody. I'm Cindy Merlis with Callison Associates, lead counsel here, and we're going to walk you through the important aspects of the PPM documents.
Hi, everyone. I'm Greg Ehrlich. I'm the associate attorney here, and thank you, James, for letting us speak this afternoon. And we'll walk you through some of the things to look out for and just some things to be aware of as a passive investor. So I think we're ready for the next slide. There's just a little bit of background on us. You can go to the next slide too, James. So the first thing,
the first thing when you have your deal sponsors and you're inquiring and wanting to be an investor in a deal, these are the sets of documents, the PPM documents that you're going to get from your deal sponsor. And basically, it's 4 key documents: the actual PPM, the private placement memorandum, and that sets all out all the parameters of the deal, the structure of the deal, and the risks associated with it. Your company agreement is the agreement between, if you become a member of the company, between you as a member and the manager of the company, and it also outlines how the company will operate. Let me skip down. The investor questionnaire is actually what the deal sponsor is going to use to basically vet you as an investor and determine if you are accredited or unaccredited and if you qualify to be part of the deal. And then the subscription agreement is actually the agreement where you are agreeing to purchase a certain number of units in the company, and this is basically the contract between you and the deal sponsor, that you agree to purchase a certain number of units and they have accepted you into the company.
Let me go to the...
So when you're a passive investor, really the 2 most important documents for you to review are the PPM, the private placement memorandum, and the company agreement. And obviously we can't provide you an exhaustive list of things to look for because every company agreement and every PPM are different, and they can all contain different provisions, and they often do. But this is sort of a list of some basic things to look for when you are reviewing these 2 documents that will sort of give you an idea of what type of deal you're getting yourself into. So the first thing as a passive that you're going to want to look for are how are distributions handled. And usually passives don't need help finding that section because they're in the deal to make money, and the distributions are how they get their money. So some things to think about are there two classes of members. You know, a lot of time on deals that we structure, there's a Class A and Class B. What is the split between those two classes? Is it 95-5? Is it 50-50? Is there a pref to a certain class? And also, how are your distributions being handled in terms of accounting? Are your distributions your quarterly distributions being treated as if they're a return of your capital, lowering your capital account, or are they being treated as profit above the line, essentially? Another thing that's really important to passives is our capital calls. And the company agreement will have provisions as to what can trigger a capital call. Is it based on member approval, or is it the manager's sole discretion to ask for a capital call? What's the impact of failing to contribute to this additional capital call? Are you merely going to get diluted in your ownership interest, or is it what they call a mandatory capital call, and you become a defaulting member, and you can lose voting and distribution rights until you actually make that additional contribution?
Additionally, you want to see, are you acquiring voting rights when you become a member? That's not always automatic. If not, you would merely be acquiring the distribution right. And voting rights are important because many of the functions in the company require a certain, either a simple majority of members on a vote or a supermajority, and that is also called the required interest. So you want to see how the required interest is defined. Typically, it's 2/3 or 66.67%, but that also can be changed in the document, so you want to pay attention to that. Another area that you want to be looking out for is how can you change the management. If, as members, you are not pleased with how the manager is operating, how can you make a change? And typically, it requires a vote of the members and that required interest or supermajority. But you need to make sure of the definition of required interest and what percent is required. And this is going to run over to the next slide, but also as an example, if there's 50-50 sharing and voting between the members, if the agreement requires the typical 2/3 voting, it's unlikely that the manager could ever be removed. Ooh, sorry, did you switch back, James?
Yeah.
Perhaps we can go to the next slide. Yes. So if it's a 50-50 voting ratio and it requires 2/3, it would be difficult to remove the manager, as the manager would be starting with 50% for himself. This is where you want to be incredibly careful, as it's unlikely that the documents are going to specify that the manager can be removed for this reason, and you need to make sure if you'll be left out to figure out how you review the numbers. Also, another area is the holding period. How long is the deal sponsor anticipating holding the asset? Is this a long-term hold or a shorter, let's say 2-year turnaround? And that, you will look for also in the numbers, in the PPM, in the business plan, to see how long your investment will be tied up.
So other things to look for are an early cash out. So oftentimes an investor will put in capital and the deal is not going to be sold, or the property is not going to be sold for 5 or 6 years, but year 3 comes around and for whatever reason, they need the money back. Is there a provision that allows you to be bought out prior to the sale of the asset? How do you determine the buyout price? Is it based on your initial contribution? Is it fair market value at the time you're being bought out? Or is it just a mutually agreeable price between the selling member and the company? Those are obviously a concern, especially you never know with the economy going up and down, and you never know when you'll actually need that cash. Another thing is the first distributions. Oftentimes on these deals, the company needs some buffer time to either bring in additional tenants to get the rent numbers up or to do repairs around the property and improvements. So usually the initial distributions are not going to happen in the first couple months. Is the first anticipated distribution 3 months later, or is it going to be 2 years after the purchase of the asset?
So a question that we often get from passive members is, what is the extent of their liability in the company by joining as a member. And typically, the passive's liability is limited to the amount of your investment. So that means what's at risk is what you've put in, and that's all. A caution is if a passive starts to take over what would be considered managerial roles and responsibilities, even if it's not formally documented, that can bring about fiduciary liability or liability to the other members, so more of a managerial function. So in order to avoid this, you basically want to stay in your role as the passive member. And normal things for a passive member to be able to do are calling for votes, voting, asking to review financials. Those are all normal functions that a passive is expected and allowed to do.
So we're getting into the offering types, the offering exemptions that you can use to essentially raise capital in a way that is compliant with the SEC rules and regulations. And one thing that's important to understand before you go into that is what an accredited investor is. So an accredited investor is someone, an individual with annual income of over $200,000 per year for the prior 2 years and a reasonable expectation that that income will continue. Or if you're investing with your spouse, an annual income of $300,000 for the prior 2 years, and expecting that with a reasonable expectation of that continuing. You can also be qualified as an accredited investor based on your net worth. If you have over $1 million in net worth, excluding the value of your primary residence, you are an accredited investor. This one probably won't apply for anyone here, but if you're a bank, an insurance company, or an employee benefit plan, if you have over $5 million in assets, and if you're a business entity, if it's over $5 million and not formed for the purpose of acquiring the security interest offered. So essentially what that means is a lot of time in these deals, someone will form an LLC to invest in another deal. The question for that is the member who is unaccredited, if there's 3 members that are unaccredited in that LLC, what does that count towards your unaccredited account? Well, if it was formed for the purpose of investing, then for purposes of calculating the number of unaccredited investors, it's treated as if all 3 are separate purchasers, and it counts as 3 unaccredited investors towards your limit.
So the 506B offerings are probably the most typical for these type deals that are being contemplated, the purchase of multifamily properties. Reason being that they are less burdensome to the deal sponsor, but the restriction on a 506B is that you cannot use any type of general solicitation or general advertising. So no putting things up on Facebook, taking out a TV ad, anything like that. What this does allow, the flexibility part, is that you can take up to 35 non-accredited investors as long as they're provided the extensive information about the deal sponsor, and that's why you do the PPM. No general solicitation or advertising, and the deal sponsor can only approach investors that they have what's called a pre-existing relationship, or known investors to the deal sponsor. And the kind of rule of thumb is recommended at least 3 meetings or contacts with the potential known investor. Or you could utilize a licensed broker-dealer to acquire your investors. That's a little bit more costly endeavor. And then the burden is on the investor, the accredited investor, to self-certify their status. And then the PPM with full disclosures is required.
And I'll add one thing in terms of the pre-existing relationship with your potential investors or with your investors. A question we always get is, well, when must that relationship exist for them to invest in my deal? And the answer for that in the real estate context is the pre-existing relationship must exist prior to the property going under contract. So if you meet someone that you want to invest in your deal after you're under contract, you are in violation of the SEC rules. You can take them certainly on your next deal at that point, but the relationship must exist prior to going under the contract. So the next type of offering exemption that some clients choose to use, this one is not nearly as popular of an option. It's relatively new legislation in the last 4 or 5 years, is 506C. And what 506C allows is general solicitation and general advertising. So you can post on the internet, you can take out TV ads, you can do radio ads, you can do all forms of social media, you can do billboards, you can do cold calls. There's a couple catches though. So the first catch is that you cannot have any non-accredited investors participating. So obviously you won't know their status as you're advertising, but once you sort of ascertain what their status is, once you determine that they're unaccredited, they are not allowed to be in this deal. So the other main catch is that as opposed to under 506B, where you can essentially rely on their investor questionnaire to determine whether or not they are accredited, under 506C, the issuer, or the lead sponsor essentially, is responsible for verifying the accredited status of each investor. And we'll get in on the next slide as to how you do that. Under 506C, because you are only going after accredited investors, the disclosure requirements are not the same. They're not quite as high. However, we always recommend using the PPM and making all the disclosures regardless of whether or not it's only going to be accredited investors.
Okay, so as Greg said, the deal sponsor is required under a 506C to verify that accredited status. So factors that you can use or you use to verify that is the nature of the purchaser and the type of accredited investor the purchaser claims to be, based on the rules of what constitutes an accredited investor, the type and amount of information the deal sponsor has regarding the purchaser, and the manner in which the purchaser was solicited, and then the terms of the offering. Income verifications require W-2s, 1099s, K-1s, or 1040s, anything that shows the investor's income for the last 2 years, and then a written representation from the investor that they have a reasonable expectation that the same income from the last 2 years will be the same going forward.
So if you're wanting to verify via the net worth, or if you're wanting to be certified as accredited via the net worth requirement, the documents that would be provided would be bank statements, brokerage statements, other statements of securities holdings, certificates of deposits, tax assessments, appraisal reports. Liabilities obviously need to be disclosed as well. The SEC has required obtaining a credit report and a written representation from the investor that all liabilities essentially have been disclosed.
And another way for a deal sponsor to meet the burden of verifying in the 506C, you can use what's called a third-party verification. So there are companies or registered broker-dealer or an investment advisor, a licensed attorney, or a CPA that can provide that written confirmation. Also, if the individual is a previous investor in a 506B rule and was deemed accredited prior to September 2013, and they're still an investor in the 506B, then the issue is deemed to satisfy the verification requirement of 506C.
So there's some things to think about if you're going to engage in a 506C. If you engage in general solicitation or general advertising, and you can't attract the number of investors or the amount of capital you want to bring in, and you decide, well, I really need to bring in, unaccredited investors to get that capital amount to where I need it. Well, at that point, you've blown your chance of doing that, because the second you advertise generally or solicit generally, you cannot go back to 506B. So there's some consequences if you can. And 506B and 506C are exemptions from registration. So if you conduct a securities offering without a valid exemption from registration or without registering, which is essentially what the publicly traded companies do, you can be subject to civil enforcement action, liability, criminal enforcement action, and the purchasers have the right to rescind their investment, in which case the principal, the lead sponsor essentially, would be held personally liable to refund that. So it's something that you need to be very careful of before you go into 506C. You would file Form D before and at the conclusion of the offering. That's something your law firm would handle for you. Another thing that's actually very advantageous about 506C is that, let's say I decided to do a 506C offering today, and I do all this advertising, and obviously some unaccredited investors capture the advertising and are interested in investing. Well, we know that I can't accept them in this deal. But let's say on my next deal, I want to do a regular 506B offering. Well, assuming that I'm developing a substantive pre-existing relationship with those unaccredited that I met through the advertising, I can then bring them in on my next deal on 506B and not be violating any SEC rules.
So this legal timeline is a flow chart that we've put together for anyone on the call that is thinking about being a deal sponsor, and kind of gives you the idea from start to finish. If you were to engage a law firm, what functions we provide. So basically, if you are under a letter of intent that's been signed, that's when you want to engage a law firm. And then what we provide is everything from contract to closing. So the contract review and negotiations, title review and objections, all the PPM documents and the SEC filings, as we've talked about, lender due diligence, and then all the way through closing. So just something to keep in mind if anyone out there is considering being a deal sponsor.
And then just some things to look for in a law firm that if you're going to be doing this type of investing, especially as a lead sponsor, you want the firm to deal with multifamily and other commercial real estate, malpractice insurance covering SEC work. One thing that, as Cindy said, that makes us very unique compared to a lot of other law firms is that we're essentially able to help you with the entire transaction. You know, there are other law firms that will only handle the PPM and the security stuff, and then separate law firms that will handle the real estate side of things, where we differentiate ourselves that we really can do all that at once for you. And then obviously ask other leads and issuers who that they've used and who they recommend.
I think that's it, right? Should we go for the Q&A?
Sure.
Okay, so I'm just opening up the Q&A box. I'm not sure whether the attendees can see it. Let me see.
Can't see it yet.
You can't see it yet? Okay, hold on. Let me ask the attendees, can you guys see the Q&A boxes? Okay, so there are people asking questions. So can you see the question?
Well, we cannot right now.
It looks like there's two boxes too. It looks like they've been asking questions in the chat.
Yeah, yeah. Let me see. Okay, so let me see. The first question is, can you please explain the capital call?
Sure. So what a capital call is essentially is that once you've already closed on the asset, the company is operating, a capital call is, depending on if it's the manager or how the company agreement is written, it's essentially the company asking for additional funds from its members. So for whatever reason, they're short on capital, they don't want to get a loan, and they need additional funding. And again, the circumstances that would surround the capital call would be different in each deal. You know, whether or not it's mandatory, whether or not the only impact is dilution, whether or not it can be triggered solely by the manager, or it would have to be triggered by the affirmative or the required interest of the members. That would all be different from deal to deal. But the capital call in general is just the company asking for additional money from its members.
And I will add that typically on the company agreements that we draft, we don't automatically put in any type of mandatory capital calls unless it's requested. Typically, it's not a mandatory capital call, so the members would have the option to participate or not.
Okay, the next question is basically, what was that about Blue Sky?
So a Blue Sky filing is, well, let me back up. When you do one of these type of offering exemptions, you're required to file with the SEC. That's Form D. However, you're not subject just to federal laws, you're subject to state laws too. So whichever state your investors are residing in, you are required to file with that state, essentially putting the state on notice that you're raising capital from its residents. So regardless of whether you have one investor from a state or 20, essentially just about every state will require some sort of filing to put them on notice that you are raising capital in their state.
And the short term for that filing is called a blue sky filing.
Okay, so I'm taking some questions from the chat box as well, because some people cannot see the Q&A box.
Okay.
Can passive investors still certify as accredited? Still self-certify as accredited?
So under 506B, they would essentially do that through the investor questionnaire. Unless the lead sponsor has reason to believe they're essentially being dishonest on the investor questionnaire under 506B, then they can self-certify. Under 506C, they cannot. It is the issuer or lead sponsor's obligation to independently verify.
Okay, thanks. So the next question is, what is that 1 hour meeting referring to under capital raise? 1 hour per prospective investor or only committed
Yeah, so
investor?
that's something we offer to our engaged clients if we're working on the transaction for the start to finish. We'll offer a 1 hour meeting in our offices that we cannot give legal advice, but it basically the lead sponsor comes in and we answer questions similar to this webinar, really, about things to look for in the PPM, explanation of the documents, and so forth. So it's just an extra service that we as a law firm offer.
Okay, the next question is, can we get a copy of the slide deck? Yes, we will make it available after the meeting, the slide deck and the recording. The next question is a letter from my CPA good enough to verify my accredited investor status?
Yes, yes, the CPA is one of the professionals that can verify your status under 506C. Essentially, the way it works is that not anyone, but you have to have a license really that could be revoked for you to qualify to be one of those independent verifiers. So it's an attorney, it's a CPA, it's a SEC registered broker dealer, SEC registered investment advisor. There's actually for leads, there's actually a website in California, a law firm. I think it's verifyinvestor.com, where they charge, I think it's $70 or $75 an investor, and they'll take the pertinent financials and they will certify them as accredited or not.
Okay, next question. Can the syndicator reserve to themselves a 20% interest in the company that purchases the property? This interest would not arise from capital contribution made, but is retained by themselves on formation of the company, i.e.
Yes.
LLC.
So that is essentially the two-class structure that we were discussing earlier. That's often referred to as Class B, and you can reserve however much of the company you want. Obviously, it would be disclosed in all the documents, but you can reserve 20. I think we've seen anywhere from 50 to 0 reserved.
Okay.
And then also the lead sponsor, whatever term you're using, can allocate that percentage however they see fit. So often what happens, if it's let's say they're reserving 20% and they have 2 guarantors on the deal as well, one way of incentivizing the guarantor to sign on the note is to provide them a portion of that reserve percentage, essentially.
Okay. Next question is, how do I, as a member, obtain a list of other members and their contact information in the passive investments? For instance, we want to communicate and potentially change the company management.
Okay, that's a good question. So actually, the Texas Business Organizations Code has a provision that if a member of the company makes a written request to the manager to see the membership schedule and the company agreement and their contact information, the company is legally required to provide it.
Yep. You'll also be able to see it in the Schedule A as well, right? Because that has all the information.
Yeah.
Correct.
Yeah.
That was sort of assuming the issuer hadn't given you the Schedule A.
Okay. Okay.
But you are legally entitled to see that if you make a written request.
I think that's the questions. Any other questions? Okay, one more question. Can you legally offer shares in lieu of money to non-securities licensed people that help find and raise equity funding from investors?
What it sounds like he's asking is, can I give a referral fee for finding investors? And the answer is absolutely not. Unless they're an SEC registered broker-dealer.
But if you're a GP in the company, can you do it?
Like if you're partners, if you're both lead sponsors, can you both bring in your own investors? Is that what you're asking?
Yes, correct.
Yes. So more than one person can bring in the money. But if I'm just a regular member and I say, James, I got 10 people that really want to get in on this deal, and I'll lead them to you. You just got to give me an extra 10% of the company. That is absolutely not acceptable under the SEC rules.
Okay. So if you're a GP, you can do it, but if you're a limited partner, you can't do it.
Yes.
Is that right? Okay.
Now, and you wouldn't, it can't be transactionally based. So it can't be like, well, this GP gets 1% for every investor they bring in. They either have the 10% because they're a GP and they bring in their investors. It can't be transactionally based compensation, if that makes sense.
Okay. Okay. Got it. Any other questions? I think that's the questions we have. Please use the chat box or the Q&A box to ask question. I think some people could not see the Q&A box. Any other questions? Last round. All right.
Speak now or forever hold your peace.
Yes, speak now or just keep on signing that legal documents, right? So I think that's it. Thanks for attending.
I think we just had another one.
We're going to be sending out the slide deck and the recording once we do some edit on the front end to everybody who attended and registered. I think that's it. Thank you very much.
Yes, thank you for having us here. We appreciate it.
Yep. Thanks for sharing all your legal knowledge. All right. I'm going to end the webinar right now.